Good evening, friends. This is again Rohit Devangan presenting you a very interesting topic, which is volatility-based screeners using standard deviation. And as we do in all the other presentations, we'll give you brief concepts, and then we'll show you how to use them in custom screener. Right. So let's get into this presentation. So what we are presenting today is volatility using standard deviation. So what is volatility? Volatility is sudden movement of any price or some abrupt change in any situation is volatile, right? So any sudden movement of or stock price in either direction, whether upward or lower, is called will make it volatile, right? Which becomes little unpredictable, that the movement can be a little out of normal, right? So the higher the volatility is, the risk is higher, because you can't predict how far can it go. Generally happens after any news related to company or global macroeconomic situation, and very soon we'll see, or we are already started observing volatility because of our election timing, right? And likely to continue at least till 4th, or maybe few days after 4th, purely depending on how the results are. Okay. Why it is important? It helps you to mitigate risk. If you see that there's higher volatility, then chances of your wealth erosion is much higher. So if you are a faint-hearted person, whenever you see volatility, whether in the market or in the stock of your choice, try to stay away from it, because that's where sudden destruction of wealth can happen, right? But at the same time, if it goes in your favor, then there's a sudden increase in your fortune. So different people use it in different ways. Either you abstain or you aggressively get into this, because there's a risk reward ratio is being much higher. Okay. Common measure of volatility. I'm sure a lot of you have been hearing this term VIX index, and something which we see in the market. So that's a measure of volatility. Another volatility we keep on hearing is in the option world is implied volatility. Implied volatility generally is something which tells about the future volatility. Then you have relative volatility, which is your volatility if your asset class is volatile, right? But if what you are comparing with is equally volatile, then it's less volatile. For example, if Nifty is volatile and your asset class is also volatile, then your asset class may not be classified as highly volatile, because the entire market is volatile. So that is relative volatility, or beta. We have that in TSR. Won't go much deeper into that for sake of this session. Then individual candles can help you to tell what the volatility is. For example, long candle, doji candle, boring candle, that tells you if there is a series of doji candles, then it is less volatile. If they are long-legged, long white candle, or a series or three white soldiers, then obviously the volatility is higher, right? Then you have historical volatility. The volatility is calculated based on the historical price. For example, Bollinger Band or MA channel. Even beta is part of historical volatility. You have narrow range breakouts, and what we are going to cover here is standard deviation. Okay. So what is standard deviation? Standard deviation, as the name suggests, it is deviation from a certain standard, right? So what that standard here is, the standard is mean, how far your price moves away from the mean, right? It's called standard deviation. It's a measure of that. It's a little more complex, but to make it really simple, is that how far your stock moves away from your mean is average, how far it moves away from your average, or simple moving average, to make it even simpler, right? Or make it more familiar with the terms you are more comfortable with. Okay, so there's a formula out here. If you want to just miss out the slide, feel free to miss out, as we have done in a lot of our school days, right? It gives headache, but you don't need to know the formula. We have values calculated for you. All right. So standard deviation interpretation. So if the standard deviation is low, that means your price movement is very close to the mean, or close to the average, or its volatility is low, right? If the standard deviation is high, as we see here, it is far higher than that. And you see the curve, right? The curve is much more like this thing, not too far, and it's pretty wide. Whereas, and all the distribution is happening this from the center point of it, this being a very standard curve, it's spread while across. So the data points is very close to the mean for a very long period of time. Over here, if you see the data, the data is very much scattered towards close of it, or high volatility means the data is much more closer to it. We'll see how to interpret using a standard curve or a normal bell curve. Okay. So what bell curve or normal distribution is, generally, if you have a lot of data over a period of time, generally maximum things falls into a bell curve or normal curve or Gaussian curve, Gaussian distribution, right? So what it tells is that in a normal scenario, 68% of the time, 68% of the time, the movement or whichever space it is, whether it is a physics or it's some economics or any natural thing, 68% of the time the movement is within one standard deviation, 95% of the time is within two standard deviation, and 99.7% of the time is within three standard deviation. So let's say you are a risk manager. You can use these numbers depending on your risk profile, that how much money you need to invest on a particular stock where where it is within those standard deviations, right? So very important, or the most basic thing for risk managers is to use this standard deviation. So in a normal situation, 95% of the probability is it will be within two standard deviation. In coming slides, we'll understand how to utilize these standard deviations. Okay. Standard deviation in market terms: lower standard deviation, low volatility; higher standard deviation, high volatility, which we have seen it. Volatility can be used for identifying potential breakouts, breakdowns, or consolidation, right? Lower volatility means it's consolidating. We'll see that in coming slides. Okay. Volatility-based screeners in TSR, we have quite a few volatility-based screeners. Bollinger Band being one of them, average to range, narrow range, open range, previous range. These are all volatility-based, where you see that it's in a certain range, and when it breaks, it goes into higher direction. Right? Candle types: boring candles, doji, long-legged doji, a white candle, pin bar. All these things are individual candles, which tells you that what the volatility is on an individual candle level. Rectangles are there where the stock moves in a particular zone. And finally, what we want to cover here is standard deviation. Right? So standard deviation and TSR. So you can compare absolute numbers. You can go for trending standard deviation, deviation to price, deviation with its average, or historical versus standard deviation. So we'll see what these things are. It might look little Greek to you or little difficult to you. Let's try to go into the product. That's where the real fun or excitement or learning starts, right? So we go into a standard our homepage. On left hand side, you'll find custom screener. When you click on custom screener, in the technical indicators, you'll find standard deviation. Over here in the volatility section, you have the standard deviation. When you click on this, you have few options. Generally, the more common options, or the options that we saw in the slides, are like absolute number, less important, trending. Right? So if you are looking for some stocks where the standard deviation is trending down, let's say for 10 days on let's say a basket of NSE 500. So you'll find those stocks when the standard deviation is trending down, that means it's coming down. It means that it is more towards consolidation, or the heavy volatility is little vanished. Right? So when you look at the stocks, you'll find that stocks, the volatility is standard deviation is coming down. So is the volatility. Over this period, the volatility was much higher. Right? As I mentioned, it's a risk reward thing. So if you take risk during this time, the rewards are much higher, right? So that's one way of looking at it. So what we are looking here is standard deviation coming down, which means that it's getting more towards the narrow range, right? It's for low risk. Over here, the standard deviation is coming down. That means it's lower risk stock, right? Same way, you move to other stocks. There are various different ways of finding this thing. So just opposite of this is standard deviation trending up. Here you'll find stocks where the volatility is increasing, right? So when you look at the stocks, these are the stocks where the volatility is increasing. So it was pretty flattish out here, right? Then suddenly, when the market started making a bigger move, this has started giving started moving high. So this is much more higher volatility. From this zone, it has gone down, then crossed up. Similarly, you may find certain stocks which are just going in one direction. So Volatility doesn't mean bad thing provided it's going in the right direction. So maybe interesting thing is to see how you can use this volatility for your better things. So what we have used is standard deviation trending up. Same way we can add another indicator where the 20 moving average is trending up for 10 days. So maybe 15 days, that's good enough. When we click here, you'll find the certain stocks where standard deviation is going up, so is moving average, right? So you can use standard deviation along with another indicator out here to see that where the trending stocks are, where you can get into the stocks or ride the wave, right? See, so even though it is high volatile, using with right set of combination may yield you pretty favorable results, right? So very interesting thing of relating standard deviation with moving average. Okay, then what up trending down? Okay, so that was moving average. Sorry, I go back to standard deviation. So what we had is trending up and trending down. Then another thing is that if you want to see that, you know, where the standard deviation is below its moving average. So you have standard deviation, the moving average of standard deviation, and it is below that. That means is much lesser volatile. Okay, so when you look at the stocks, you'll see stocks where it is trading below standard deviation. So this is the moving average of standard deviation. It is trading below, so that means it's less volatile. It's another measure of monitoring it. See, very good quality stocks are coming out here, right? Very good quality stocks, which is non-trending stocks. You'll find with this combination, you'll find a pretty good non-trending stocks, right? Very nice non-trending stocks is something you can find. Start observing them, and wait for the proper breakout or breakdown. You'll find very good quality results. If you have seen over here, right, even so if you see the standard deviation is 30 here, it is 419, and still they are low, standard deviation, or still on they are on low volatility, right? So if you just look at these numbers, this will not give you any value. That's why we had so many options. There are certain users who would like to use it, but it's kept for them. But the real usage is don't look at them in absolute unless you know what you are doing, and there are people who know what they are doing, right? What you should be looking at is, say, 30 on 24, right? Sorry, 24 on 823, 370 on 26,000, right? So what makes sense is to have the relation between the two. That will give better idea. So what you should be looking at is, instead of that, what you should be looking at is standard deviation by price. If you see below, let's say 3, okay, when you run this, you'll find stocks where standard, which are much more in the consolidation zone. Okay, so you see these stocks, they are much more in the consolidation zone, right? So it always makes sense to look at standard deviation and price together. A combination of these two things will be good. Now, standard deviation or technical indicators being lagging, you'll find certain things where this is already going up. We are looking for low of this, but still this is going up. So how do we control it? There's one way. You go into historical DIY comparison. You can select standard deviation below its previous one. So anything where the standard deviation is just rising, you'll get those things will get filtered out. So you have much lesser number of stocks where you'll find much better standard deviation. Also, if you add on top of it is we again add another standard deviation, and over here what we'll say is it's below its moving average, right? So we have added 3 conditions on standard deviation to get something more of a consolidation zone. Let's see what results we are getting. The results we are getting should be much more flattish kind of stocks now, right? So with more combinations, you can fine-tune, filter things which are much more flattish. So a lot of people look for stocks which are in consolidation zone. They keep in their radar, and then they wait for the breakout or breakdown. Or if the stock itself moves in a very narrow range historically, then those entries and exits can be a good entry exit point for your small trading, and use the extreme level for your stop losses, right? Use the extreme level for stop losses. So this is one of the way of looking at the standard deviation. And just like this, what we have shown so far, you have just opposite of that. what we have seen is standard deviation to price. You have price to standard deviation, price to standard deviation percentage, or there are other things which you can always use it, right? Now, what we have seen is the standard curve, right, over here, which is where is it? This one, right? We'll come back to this particular again, right? And there was a specific reason why we got here. Now we have got a little bit idea about it, that 95% of the stock remains within two standard deviation. Now there's a very important indicator and powerful indicator which is built on standard deviation, which is Bollinger Band. Okay, so when you look at stock which is within Bollinger Band, right? So maybe price. Okay, so let's look at any stock for that matter, right? So when you plot Bollinger Band for this one, when you plot Bollinger Band, 95% of the time, unless it's a stock which is very volatile, generally let's go into something which is much better, let's say Nifty, which is a representation of all stocks. So that will be a good candidate. So what we have seen is 95% of the time the stock is likely to be within this particular time frame for a non-volatile stock or a non-beta stock, right? So if you see here, there's one way of doing it. Bollinger Band, what it does is, this is 20 SMA and this is 2 standard deviation. So 95% of the probability it's going to be remaining here. So what a lot of users do is, whenever it comes very close to it, then they go into reverse position. Whenever it comes very close to it, they take the higher position, right? Because the probability is 95% of the time it's likely to be here. So that's one strategy, using Bollinger Band and standard deviation. The second strategy is what we have seen is 99.7% it is likely to be within 3 standard deviation. So over here what you can do is, you can change it to 3 or a slightly higher number than 2, and then you'll see that it rarely gets crossed, right? So you look at the charts, it might cross only in the real exceptional scenario, maybe something during COVID time, or those times, maybe at some exceptional time, only those situations will get crossed. So those can be a good entry and exit point, like here. Even during Corona time, 2020, it didn't breach that level, right? So it's considered to be pretty safe and secure. If it is within 3 standard deviation, you can go into the reverse position. It's likely to be pretty safe and sure. Likewise, you are not restricted to standard deviation, 3 standard deviation. You have an option in the charts as well as in the screener. In the screener, you can always set what standard deviation do you want. 2, 3, 2.5, 1, 1.5. When we take it to 1, let's say, right? We'll take again example of Nifty with 1 standard deviation. With 1 standard deviation, we will see that, the probability of breaching that level is much higher, right? Breaching that level is much higher, right? The probability of breaching that level is much higher, because that's how the narrow volatility zone you have. Okay, so that's pretty much what I wanted to cover about standard deviation in this session. We hope that you liked it, right? What we have in the presentation after this, I think we have covered pretty much about it, comparing absolute numbers, trending standard deviation to price, standard deviation its average, and you can also say that whatever the standard deviation vis-a-vis previous levels, right? Like in this example, we close this, we go here, and I want standard deviation to be much lower than previous level, right? So sorry, not this one. Yeah, over here you select standard deviation, it is below or above previous level, then the previous is again below the previous level. So you click here, you can go back in the history, that p minus 1 is less than p minus 2, so that you can create your own trending, and by, let's say, 5% or by 5%, right? So this is where you see that there's some sort of standard deviation or volatility getting reduced, right? So when we run this, you'll see that stock where the sudden volatility is dropping, like over here there's volatility dropping, and you can see this as a flattish curve, right? So another way of seeing where the volatility is suddenly dropping, right? So what we have seen is 2. If you add more conditions, then you'll find even more stringent. But this simple indicator, using the historical value, you'll find that you find extremely non-volatile share, right? Like this. So even though this seems to be like a pretty violent, but the reflection on the stock price is much more smoother, right? So another way of looking at this one is sudden volatility dropping, and then you can look at. So for most of the easy ones, you can use for most of the easy ones you can use these settings. But if you are looking, if you're a hardcore pro, then what you can do is you can go into this volatility and go to standard deviation and play with and play with standard deviation versus its previous levels by whichever way you want to. It's very similar to the OHLC compare that we have here, or the other DIY advanced comparison like things over here. I won't go too much deep into that because that goes away from the topic. But again, a very powerful thing what you can use is a historical comparison and build it yourself, right? And that's what we say is do it yourself DIY tool. Okay, so that was pretty much what we wanted to cover on standard deviation. If you have any, if we try to cover as much as we knew at the point of creation of this using standard deviation, if there's something which we have missed, you can always write back to us using using the contact us form, or you can call us, give your strategy, and we'll try to get them implemented here in TSR Top Stock Research. Okay. So with that, I would like to take a sign off. If you like this video, do share, like, share, subscribe. That will give us encouragement that this is something which is useful to you. Thank you so much.